Hi folks. It's good to see you all here again. What is forex and how does it work? Forex, also known as foreign exchange or FX trading, is the conversion of one currency into another. It is one of the world's most active markets, with an average daily trading volume of $5 trillion. Learn all you need to know about foreign exchange, including what it is, how to trade it, and how leverage works in forex, by watching this video. How do forex markets operate? In contrast to stocks and commodities, forex trading occurs directly between two parties in an over-the-counter, OTC, market. The foreign exchange market is managed by a worldwide network of institutions that are dispersed over four main trading hubs in distinct time zones: London, New York, Sydney, and Tokyo. Due to the absence of a central location, forex trading is possible 24 hours a day. There are three distinct forex market types. Spot forex market, the physical exchange of a currency pair that occurs at the precise moment the deal is finalized, that is on the spot, or within a short amount of time. Forward forex market, a contract to purchase or sell a certain quantity of a currency at a predetermined price, to be settled at a future date or within a range of future dates. Future FX market, a contract to buy or sell a certain quantity of a specific currency at a specified future price and date. Futures contracts, unlike forwards, are legally binding. What is a base currency and a quote currency? The first currency in a forex pair is called the base currency, and the second currency is called the quote currency. Forex trading always involves selling one currency to buy another, which is why it is quoted in pairs. The price of a forex pair is how much one unit of the base currency is worth in the quote currency. What moves the foreign exchange market? Since the forex market is made up of currencies from all over the world, it can be hard to predict exchange rates because there are so many things that could change them. But, like most financial markets, forex is mostly driven by the forces of supply and demand, and it's important to know what makes prices change in this market. Central banks. Central banks are in charge of the supply, and they can announce changes that will have a significant effect on the price of their currency. Quantitative easing, for example, means adding more money to an economy, which can cause the price of its currency to go down. The news reports. Most commercial banks and other investors want to put their money in economies that are expected to do well in the future. So, if good news about a certain region hits the markets, it will make people more likely to invest and raise the demand for that region's currency. Unless the supply of the currency also goes up, the difference between supply and demand will cause its price to go up. In the same way, bad news can make people less likely to invest, which can bring down the price of a currency. This is why currencies tend to show how well the economy of the area they represent is doing. Market sentiment. Currency prices are also affected a lot by how people feel about the market, which is often based on news. If traders think that a currency is going to move in a certain way, they will trade in that way and may persuade others to do the same, which could increase or decrease demand. Economic data. Economic data is important to the movements of currency prices for two reasons. It shows how well an economy is doing and gives clues about what the country's central bank might do next. Credit scores. Investors will try to get the most money out of a market while taking the least amount of risk. So, they might look at credit ratings along with interest rates and economic data when deciding where to invest. Please let us know your views in the comments below and like, share and subscribe. Press the bell icon for more updates and stay tuned.